Hi, Tom Barnett here with the Financial Light Insurance Retirement Systems, and I'd like to talk to you today about government retirement plans. Now, these are plans that almost everybody has, but a lot of people don't realize their plans are planned by the government. They make up all the rules, they write up all the regulations. So let's kind of examine a few questions first. First question that I'd like to ask you is, what government agency do you trust? Number two, what government agency do you trust your money with? And three, what government agency actually uses funds correctly? A government agency that you feel that saves money and protects them for you. Well, most people answer every one of those questions, all three of them, the same way. And those are our popular agencies of none, none, and none. If that's the case, then my question is always the same. Then why are we putting our money into a government retirement plan? Well, first, what are government retirement plans? Those plans are basically the plans you have at work. They're called 401ks, 403bs, simple, SEPs, IRAs, Roths. They're called 508s. We have a numerous litany of different titles for each one. But all of them are a government retirement plan. What makes them that? They make up the rules, they determine the changes, and they are the ones in control of the entire process. You may be able to pick your investments, but they control every rule. That's why if you take money out, they penalize you and tax you. That's why if you don't do a certain thing by a certain age of 59 and a half or 70 and a half, they penalize and tax you. It's their fund, it's their rule, and they control it. And unbeknownst to you, with the new health care law that just went into effect, there are 23 new taxes and the opportunity for the federal government to actually go into your fund and take your money without your consent. But let's just say that everything is as it was before all this took place and we just have our 401k, 403b, or IRA. Well, one of the first things we do is we determine how much money we're going to put into that fund. So what we're going to say is we're an average person, okay, and we're in an average tax bracket. The average citizen in the United States pays approximately, those that are paying taxes, about 33% of their income. That fits about 85% of people in America. So that's their tax bracket. Now, to make this simple, we're going to say the tax bracket stays the same. Never changes, never goes up or down. It's always 33%. So that's how it works. And we've determined that what we're going to put into our fund is we're going to put in $4,000 every year, year in and year out, during our entire career of 30 years, we'll say. Which means that in that time period, by the time that we're ready to retire, we have placed within our retirement fund $120,000. Now, if we haven't been lied to yet, here's our first lie. And that is, you get a pre-tax benefit. In other words, they're not going to charge you taxes. Well, the question is it a pre-tax benefit? In other words, am I not going to pay taxes? Well, no, I am going to pay taxes. So it's not a tax break. It's a deferral is what they call it technically, or what we say a postponement. So we're going to pay taxes in the future. So the question I ask you is, if you're going to pay taxes at any particular time on your investment, would you rather pay taxes if you were a farmer, let's say? Would you rather pay taxes on the seed or on the harvest? Well, naturally everybody chooses the harvest or the seed because the harvest is going to be so plentiful. We would want to be taxed on the seed first, so that our harvest, all of our earnings and everything that we get, is free from that taxation. Well, in our government retirement plans, they work exactly opposite of all that. We aren't taxed on the seed, we're taxed on the harvest. When all of our money is supposedly there, that's when they're going to reap their benefit. And at 33%, if it stays the same, that's going to be huge. And you always have to ask yourself in the back of your mind, are taxes going to be the same, lower, or higher in the future? So you want to keep that question there. But let me ask you this. If I owe money to someone and I defer that payment to the future, I've just taken out a what? That's right, a loan. So we've just taken out a loan. If you take out a loan, whether it's on a vehicle, whether it's on a home, a stick of furniture, what is the very first thing that you want to know about that loan? Exactly. I want to know what the interest rate is. What am I going to be charged? So my question to you is, with this government loan that you just took out on taxes that are due in the future, at what rate are you going to be charged? You don't know, do you? No one does. And if you answered the previous question as I thought, that you believe taxes are going to be higher, then what you've agreed to is, I'm going to put my money into this account, and I'm going to take it out later when taxes are higher. Now, one of the myths that we're told is that, well, in the future, you're going to be in a lower income tax bracket. Do you realize what you have to do to get into a lower income tax bracket? Make less money? Is that a goal? Is that what your financial guy and gal are telling you? That, yes, when I get older and when I want to retire, my goal in life is to make less than I'm making now. And that's what I'm dreaming about. No, of course not. We want to and need to make either the same or more just based on inflation alone. You realize that just a 5% inflation ratio, that every 14 and a half years we've got to double what we currently make, not to get ahead, just to stay even. So we're going to say in this world that we just created, our tax rate's going to stay the same, that there is no inflation, and that everything just goes along copacetically as it is now. Well, on that $4,000 a year that I'm avoiding taxes on, there is a tax that's due, and 33% of that means $1,360 of that is taxable. And they're going to postpone that into the future. Well, if they postpone that then for the same 30 years, at the end of 30 years, I'm going to owe $40,800 to the government, plus whatever interest they may apply. Well, we're going to pretend that every year, and this is a far-fetched fantasy, that money that we put in every year, it always earns 10%. Every year, year in and year out, never a down market, never a troubled time. Well, now we're ready to retire, which means in that time period, our taxes have stayed the same, inflation hasn't moved, and we've earned 10% per year, which means we have over $775,000 in our little retirement chest. We should be fairly happy. Now let's just say that earnings continue to produce 10% a year, and I decide, well, since that's the case, I'm going to pull out 10% a year. So I'm going to start living on $77,500. Well, what's the first thing that they're going to take out of that money? That's right, taxes. So now 33% of that is tax, which means they're going to take over $25,000 from that account. Now, that may seem okay, that may seem fair, it may seem exorbitant, which I think it is, but I want to focus on that tax. Let's just say, to round things off, it's $25,000 is what they're taking out. I want you to multiply that times 2 years, which means in 2 years they will have taken out $50,000 of taxable income. Now, remember, what did you pay over the course of 30 years? What did you postpone and say you would pay? $40,800. So in 2 years, I have paid my $40,800 back plus almost $10,000 of interest. So wouldn't you think that in most cases that the bill is done? If you pay all of your car bill, in other words, I'm making car payments, and I pay it monthly, and I do that for the 3, 4, 5 years, however long I do that, and I make that last payment, I paid not just the principal, but the interest attached to that principal. How many more payments do I have to make? None. Exactly. Well, how about a credit card? If I make those payments, and I finally pay that off, and I pay it monthly, and I finally hit that last payment, how many more do I have to pay then? None. It's the same in every case. Why? Because I have met the principal obligations, and I've also paid the interest associated with that. So my bill is over. Well, in your tax world, you just paid $40,800, and you've paid another $9,000 on top of that in interest payments over that time period. How much longer are you going to be taxed on your money? Forever. It goes on to infinity. Well, actually it doesn't, because here's the problem. At that particular tax rate, do you realize that if you lived an average retirement age, which now is between 20 to 35 years, if you lived on the short end of 20 years, you realize that you would be obligated to pay over $500,000 in taxes? $500,000. What does that mean? That means you are going to be taxed out of your retirement before you can ever spend it out. The average retirement fund at that rate will disappear by the time you're 76 to 77 years old if you retire at age 65. That's right. 17 years, it's gone. Which means what? If you don't have extra money, you've got to figure out what to do. And the most popular things right now are, would you like fries with that? Or, hi, welcome to Walmart. Is that what you'd like to do at that time? No. Folks, there is a better way to plan your retirement. There is a better way to do it. And you can avoid government programs. But that's how the government programs work. And I'm glad you paid attention. Thanks.